The money in your checking account is not your money. The moment you hand it to a bank, it stops being yours and becomes a loan from you to them. And most Americans go their whole lives without ever learning that, because the only time it matters is the worst possible time to find out. If you have spent decades building a retirement account, that one sentence deserves your full attention because it explains the number that brought you here. Gold owners just watched their metal do something it had not done since the start of the summer. After a long, quiet, sideways drift, the kind of stretch that makes people bored and makes headlines go silent, gold broke out and pressed into fresh record territory, and the holders who sat patiently through the dull stretch were suddenly the ones being congratulated. That is the move the title is talking about, and I am going to honor it honestly. But the words "act fast" do not mean what the trading channels want you to think they mean. They do not mean chase a green candle. They mean something older and calmer than that, and by the end of this video you will understand exactly what. Here is the down payment, and it is not a price, it is a memory. A few years back, one of the largest banks in America went from open for business to seized by regulators in less time than it takes to plan a wedding. Ordinary depositors, people with payrolls and savings sitting in that bank, discovered in a single terrifying stretch that a deposit is not a possession, it is a promise. And while that promise was cracking, gold jumped. Not because of a rate decision, not because of an inflation print, because confidence broke. And that is the core answer this video owes you, stated plainly, up front. Gold's biggest weeks almost never come from good news. They come from cracks in the system, which is exactly why you own it before the crack, never after. Stay with me, because there is a man in Kansas whose whole working life explains this better than any banker ever could, and what he kept in his own back bins is the deepest part of this story. Let me introduce him. Picture a retired grain elevator operator from Salina, Kansas. Call him Harlan. For better than 3 decades, he ran the tall concrete elevator you can see from the highway, weighing wheat trucks in and out during harvest, pushing the moisture probe into every load, writing scale tickets, issuing warehouse receipts to farmers who hauled in their crop and drove home with a piece of paper instead of grain. Harlan understood something in his bones that most people with money in a bank have never once thought about. When a farmer stores wheat at the elevator, that wheat is not sitting in a labeled pile with his name on it. It goes into the common bin. What the farmer actually owns is a claim on the elevator. And Harlan had heard the old stories. The elevators in other counties that went broke over the years with the bins emptier than the receipts said, and the farmers who showed up with paperwork in hand and left with a fraction of their crop. Keep Harlan in mind. We are coming back to him. Now the bank. In the early spring of 2023, Silicon Valley Bank was one of the 20 or so largest banks in the country, the house bank of the technology world, stuffed with deposits from startups and funds. And here is the mechanism. Because in my years in the gold and silver world, I have learned that the mechanism is the part the news always skips. The bank took those deposits and parked an enormous share of them in long-dated bonds, the kind of paper everyone calls the safest thing on earth. But long-dated bonds carry a quiet trap. When interest rates rise, the price of an old bond falls, because nobody will pay full freight for an old low coupon when they can buy a new bond paying more. So as the Federal Reserve pushed rates up, the market value of that safe pile sank, month after month, in plain sight of anyone who read the filings. Then the depositors noticed. And this is where the story turns modern and frightening. There was no crowd on a sidewalk, no line outside a branch, no teller windows slamming shut. The run happened on phones. Word moved through group chats and message boards. Withdrawal requests moved at fiber optic speed. And in roughly the span of a weekend, a bank that had stood for 4 decades simply ceased to exist as an independent institution. Regulators seized it. Days later, another sizable bank followed it down. Washington scrambled, guarantees were announced, and the Federal Reserve opened an emergency lending window to keep the panic from spreading to the next bank on the list and the one after that. Think about what every depositor in America was forced to learn in that stretch. The insurance on a bank account has a ceiling, and plenty of people and businesses were sitting far above it. Above that ceiling, a depositor is just an unsecured lender to a private company, standing in line behind the lawyers. The sound bites had insisted the system was sound almost until the moment the doors were sealed. And while all of that unfolded, gold did what it has done through every one of these episodes I have watched in my years around this market. It jumped sharply in a matter of weeks, because a slice of the country stopped asking what pays me the most interest and started asking a much older question. What do I actually own, and who has to stay solvent for me to keep it? But here is the part that never made the evening news, and it is where this gets bigger than one bank. That episode was not an exception in gold's history. It is the pattern. Think about the night Britain voted to leave the European Union. Markets were leaning the other way. The results landed after hours, and gold spiked hard overnight, while people who had panicked out of positions earlier paid dearly for it. Think about the panic of 2020, when the New York futures price of gold tore loose from the price of physical metal in London. Planes were being chartered to move bars across the ocean, and vault logistics became front-page news, a rare public glimpse of the fact that a paper claim on gold and a bar of gold are not the same thing. Crack after crack, decade after decade, the metal's biggest moves cluster around the moments when a promise somewhere stopped being believed. Gold is not really a bet on inflation or a bet on rates. It is the asset that answers to no promise at all, and it gets repriced every time a promise fails. Harlan could have told you all of this without a single chart, because he lived inside the grain version of it. He spent his career issuing paper claims on a common bin, and he was scrupulous about it, because he knew exactly what that paper was worth if the bin ever came up short. And here's the detail I want you to hold on to. Harlan kept a share of his own family's wheat at home, in his own steel bins, on his own ground. Not because he expected his elevator to fail. His never did. He kept it because he had seen what happened in the counties where one had, and he understood that the time to have grain of your own is before the receipts stop being honored, not after. Nobody in Salina thought that made him paranoid. They thought it made him a grown-up. Now ask yourself why nobody on the financial channels talks to you the way Harlan would. Follow the money, and it stops being a mystery. Your deposits are the cheapest raw material the big banks have. They pay you next to nothing for the loan you are making them. Lend it back out at a healthy spread, and that spread is the engine of the whole business. An hour of television that honestly explained that a deposit is an unsecured loan and that gold is the one financial asset that is nobody's liability would be an hour spent teaching you to need them less. So instead you get the word relic. You get a smirk. Gold pays no yield, they say, and that is true. And it is also the entire point. Gold pays no yield because it makes no promise, and everything that pays a yield is a promise made by someone who can break it. And the deepest irony is who actually believes the smirk, not the people at the top of the system. After a coalition of Western governments froze the reserves of a major central bank a few years ago, every reserve manager on Earth absorbed the same lesson in the same instant. A reserve held as someone else's paper is a promise that can be canceled by decree. A bar in your own vault cannot. Central bank gold buying did not just rise after that. It accelerated to a pace of more than 1,000 tons a year, and it held near that pace for 3 straight years, roughly twice the rhythm of the decade before. Poland, China, India, Turkey, and a long list of others kept adding even through price dips. And the milestone that should have led every broadcast barely got a mention. By the reckoning of the European Central Bank, gold's share of global reserves has climbed past the share held in United States treasuries, the first time gold has stood as the world's largest reserve asset since the 1990s. Read that again. The institutions that print the money and run the payment rails have quietly made the no-promise asset their largest reserve. They are not acting like the crack of 2023 was the last one. They are acting like it was a preview. And that is exactly why I put together what I did. If watching the people who run the system stockpile the exit makes you want a plan of your own, I want you to have the free Retirement Wealth Protection Guide. It was written for American retirees with $100,000 or more in a retirement account, and it walks through how folks diversify a portion of what they have built into physical gold and silver inside the account they already have, without taxes or penalties, using a self-directed precious metals IRA. This is not just for insiders or the wealthy few. If you have $100,000 or more in any retirement account, a 401k or an IRA, this is for you. It comes from our family to yours. No obligation, nothing to buy. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. Get it, read it, and then come right back, because we are not done. Because here's the piece that dwarfs everything I have said so far. One bank failing is a crack. What sits underneath the whole system now is pressure. The federal debt has grown so large that the interest alone recently outgrew the entire defense budget of the United States. Sit with that. The bill for old borrowing now outruns what we spend on every carrier, every base, every soldier. That is not a data point that changes with the next report. It is arithmetic with momentum, and it boxes in everyone who might want to fight the next fire. In the late 70s, it took brutally high rates, held far above inflation, to break gold's run. And it worked because the country's debts were small enough to survive the treatment. Try that arithmetic against the current debt, and the interest bill alone becomes an emergency. The Fed we actually have, under Kevin Warsh, is publicly divided. torn between officials who want to lean harder against inflation and the sheer weight of what higher rates cost a government this indebted. A cornered fire department arguing about the hose above a house full of dry timber. History shows you how this movie runs when the pressure finally finds a seam. At the start of the 1970s, gold was pegged at $35 an ounce. By January of 1980, it traded north of $800. But almost nobody rode that whole move, and the reason matters for you. In the middle of that decade, around 1976, gold was nearly cut in half, sliding back toward 100, and the newspapers wrote its obituary. The holders who were shaken out missed the leg where the metal multiplied roughly 8 times from that low in about 4 years. And the biggest single weeks of that entire era did not land on calm news. They landed on crisis headlines, on hostages and invasions and inflation panics, on cracks. The people who caught those weeks were not fast. They were already there. Now, let me give you the honest beat, because trust is built on the downside, not the upside. I cannot tell you gold only goes up, because I have watched it do otherwise. In 2013, nothing more than a hint that the Fed might slow its bond buying knocked gold down by roughly a quarter or more in a matter of months. Right now, long-term Treasury yields are the highest they have been in a generation, and a fat, safe-looking government yield is real competition for a metal that pays nothing. If the jobs picture and inflation cool exactly the way officials hope, gold's strong stretch could easily give way to a long, boring pullback, and you should hear that from me and not discover it alone. I will not pretend to know the day anything happens, and anyone who claims to is selling certainty they do not have. This is a case, not a guarantee, and it is not personal financial advice. What I can tell you is what the pattern has been, and the pattern is that the system's cracks arrive without appointments, and gold's response to them is measured in hours, not quarters. Now watch what happens when you flip the title's question around, because this is where act fast earns its honest meaning. The urgency is not that gold just had a strong stretch and you must chase it. Chasing is how the trading desks eat. The urgency is that everything this video described is bought cheaply only in advance. Remember the night of the British vote. By the time the results were landing, gold was already gapping. The repricing happened overnight, while the people who suddenly wanted protection were asleep, and they woke to find the insurance premium already raised. That is how it always goes. The farmer who called Harlan asking about storage the week after the neighboring county's elevator failed was not early. He was educated. Insurance is the one purchase where being fast means being early, and being early means acting while the case still feels debatable, which is precisely now, while the move in the title is still an item of curiosity instead of a national obsession. And if you are worried you have already missed it, look at what a real top looks like, because we have a photograph of one. In January of 1980, there were lines around the block at coin shops. Families melted down flatware and picture frames. The price gapped higher day after day, and gold was the lead story everywhere. That is mania, and none of its signatures are visible now. Institutional portfolios still hold a historically tiny sliver in gold. Your neighbors are not talking about it at dinner. It reminds me far more of the 2000s, when gold climbed from around $250 at the end of the 90s to near $1,900 over a dozen years, while Wall Street and the financial press treated it as a sideshow the entire way up. The quiet phase of a bull market is the profitable phase, and quiet is exactly what surrounds us, record prices and all. So here is how I would think about your own position, offered as principles and not a prescription. First, size matters more than timing. A portion, sized so that a vicious shakeout can never frighten you into selling at the bottom, beats a heroic bet that breaks your nerve. Second, own the real thing. The lesson of 2020's split between paper and physical, and the standing reality that paper claims on metal far outnumber the ounces available for delivery, is that in the exact moment you need gold to be gold, a claim on it may not be. Physical metal, properly vaulted, inside the retirement account you already have. Third, decide before the sirens. Every story in this video, the bank, the vote, the elevator, teaches the same single thing. The door is wide open only while the room is calm. The reserve managers have already walked through that door, 3 years of record accumulation deep. The pension funds, the television programs, the advisor your neighbor uses, They are still standing in the hallway, debating whether the door exists. There will come a stretch when a fresh crack makes all of this undeniable, when gold's next big move leads every broadcast, and the people who mocked it start explaining it. And when that happens, the repricing will already be in the rearview mirror, because that is what a repricing is. Understanding this while it still sounds contrarian is the entire advantage available to you. It is the only edge a retiree in Kansas has ever really had over Wall Street, and it is a real one. Being positioned before the crowd needs no speed at all. It only needs a decision made in the quiet. Harlan made his in the quiet. Those steel bins behind his place sat mostly unremarked for years, just part of the property. Wheat he owned outright, on ground he owned outright. No receipt required, no counterparty involved. And whether or not a failure ever touched his own county, every season those bins were full. He negotiated from strength, slept through harvest price panics, and answered to nobody. That is what gold in your retirement account actually is, not a lottery ticket. Harlan's back bins, the portion of a lifetime's work that goes on being yours, no matter whose promise fails, and the portion your kids will one day be very glad you set aside. Which brings me to the last thing I will ask of you. If you have $100,000 or more in a 401k or an IRA, get the free Retirement Wealth Protection Guide before you close this video. It shows you step by step how retirees protect and diversify a portion of what they spent a lifetime building and what their children and grandchildren will inherit by moving part of it into physical gold and silver inside the account they already have, without taxes or penalties. And because you stayed to the end, there is something extra. If you have $100,000 or more saved and you mention that you watched this full video, our team will set up a free one-on-one educational web conference, a real conversation with a real person, from our family to yours. No obligation, nothing to buy. The honest reason to do it now is simply this. Decisions like this one are cheap and unhurried only before the next crack, and no one will ring you when the quiet is about to end. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. So yes, gold owners just got their strongest stretch since early summer, and they earned it by being positioned before the headlines arrived, which is the only way anyone ever catches gold's biggest weeks. The money in your bank account is a loan to a bank. The wheat in the elevator is a claim on a bin. The bonds in the fund are promises stacked on promises. But somewhere in a lifetime of careful work, there ought to be a portion that is simply, finally yours, the way Harlan's back bins were his. The cracks will come when they come. Act fast just means this. Be like the man from Salina. Decide while it is quiet. I will see you in the next one.